So we are doing a little bit of ratios revision. Okay. When I talk about ratio, this chapter is really very important. The reason why this chapter is important is that it comes for 20 marks in your exams. And sometimes the calculation would come for 12 marks and the theory related to ratios would come for 8 marks. So you need to do this chapter, and once you start this chapter, I expect you to complete the chapter in 2 days, how much ever time it takes to for you to do it. Okay. When I'm talking about ratios, we have three types of ratios. Do you know the three types of ratios?
Profitability, profitability,
Profitability, liquidity, efficiency.
efficiency, and liquidity. Yeah,
Okay.
profitability, liquidity, and efficiency.
So we have three types of ratios. One is a ratio that gives us profit. One is a ratio that shows us the liquidity position of the company. And one is the ratio that shows us the efficiency of the company. When you're doing ratio, we expect a particular format of the income statement. Do you know the format of the income statement which we use in ratios?
Yes.
Say the particular format.
Revenue minus cost of sales.
Hmm.
Revenue minus cost of sales. Add other income
Hmm.
minus other expenses.
Which are the other expenses? Administrative expenses and selling and distribution expenses
Yes.
gives us the operating profit.
Yeah,
Does it give you?
operating profit.
And this operating profit is also called PBIT, profit before interest and tax. Okay, this is the profit that you use to calculate the return on capital employed. Now, I'm just going through the formulas. Profitability ratio is going to help you find all the profits that a company make. A company would make gross profit, a company makes net profit, and a company makes return on capital employed. It makes gross profit, it makes net profit. We do not use the word net profit, we are going to use the word profit for the year. And the company uses
Profit for the
return
year.
on capital employed. Never use the word net profit in IGCSE. Okay. Other thing you should remember is that markup is on cost, margin is on sales. Markup on cost, margin on sales.
Revenue.
Okay, markup and margin, they both are going to help us find the gross profit. So if I say the formula for gross profit markup, it would be gross profit divided by markup is on
Cost of sales.
markup
Cost
is
of
on cost
sales.
of sales. So if I have to find the gross profit markup, I would say gross profit divided by cost of sale times 100. If I have to find margin, the formula
Yeah.
would be,
Revenue.
if
Gross profit upon revenue times 100.
if I want to find the profit for the year, the formula would be profit
Profit for
divided
the
by
year is
revenue.
profit upon revenue.
Okay, now which profit are you going to
Yeah.
take? That is very important. We are going to take the very last profit. What is our very last profit? From the operating cost, you will also subtract the finance cost. What comes in the finance cost?
All the interests and your preference dividend.
Interest and preference dividend. Which interest? The debenture interest and the preference dividend. After you minus the finance cost, the main profit that you get is your profit for the year. I hope you're with me.
Yeah.
Okay. So,
Yes.
profit for the year, the formula is profit divided by revenue times 100. And the last one is return on capital employed. Return on the capital used in the business. The formula is PBIT divided by capital employed times 100. Now, one thing you should note over here. Can you tell me where is the PBIT?
Operating profit in
Operating.
the income
Lovely.
statement.
Yes. And what is capital employed?
Capital employed is total assets minus current liabilities
But what is
or
the meaning of
shareholders
capital
funds
employed?
minus non-current liability.
What is the meaning of capital
Like how
employed?
much capital is being used in the business currently.
How much capital, or I could say how much money is being used in the business. So, what is the money that is
Yeah.
used in business? It could be your own money. Your own money is called capital, or it could be outsiders money. Outsiders money is called non-current liabilities. I hope you're with me. So capital employed
Yeah.
is a summation of your capital plus your non-current liabilities. What is capital? Capital is own money.
Capital is
Own money
your,
means capital. Capital employed means own money plus
yeah.
outsider money, capital plus non-current liability. Own money is capital, non-current liability is outsiders money. It could be bank loan, it could be debentures. These are your long-term loans. When you add both of this, you will get capital employed. Please, you are with me.
Yeah.
So capital employed means money used in the business. There are three ways to calculate capital employed. Please note if I am making my balance sheet. Okay. If I make the balance sheet of the company, the balance sheet would have a liability side and it would have an asset side. The
Yeah.
assets is made up of non-current asset plus current asset, which is going to give you your total assets. And the liability side is made up of capital plus non-current liability plus current liability, which is going to give you your total liabilities.
Yeah.
Capital employed is actually this blue part that I have highlighted. Capital plus non-current liability. But if I want to find another formula for calculating this blue part, how would I do it?
Total assets minus current liabilities.
So it would be total assets minus current liability, or I would say it is total liabilities minus current liabilities. I hope you're
Yeah.
with me. So can you give me the
Yes.
four profitability ratios we studied right now? Four profitability ratios we studied right now. Gross profit margin, gross
Gross,
profit margin. Yeah, please tell me.
gross profit margin, gross profit markup, ROCE, return on capital employed, and
And
profit
Profit
margin.
for the year.
profit margin. Okay.
Profit
What's the
margin.
formula for gross profit markup?
Gross profit markup equals to gross profit upon revenue. No, gross profit upon cost of sales times 100.
Gross profit margin.
Gross profit divided by
Gross
revenue
profit.
multiplied by 100.
Okay. Return on capital employed.
Net profit before interest divided by capital employed multiplied by 100.
Okay. And profit margin.
Profit for the
Profit
year divided
margin
by
is profit for the year upon revenue times 100.
How do you find capital employed?
capital plus
Non-current
liabilities.
Okay. Another formula to find capital employed.
uh, shareholders funds minus non-current liabilities.
Darling, capital employed is this blue part.
Total
Oh
liabilities divided
yeah,
minus current liabilities.
Total liability minus current liabilities. Another formula to
current liabilities.
capital employed. Another formula to find capital employed. Total assets minus current liabilities. I hope you're with me.
Yes.
Yeah,
Okay. Now, one more thing you have to note over here that the profitability ratios are all has to be expressed as a percentage. So if you have the gross profit, you're putting times 100. This is also important. There is a mark that is allocated for this and you have to put percentage. Okay. If it is 10% or 10.06%, you will express your percentage up until 2 decimal points. The question would mention it to you clearly that express up to 2 decimal points. So you will express as a percentage. Putting a percentage sign is mandatory. Profit margin, return on capital employed, gross profit markup or gross profit margin. I hope you're with me.
yeah,
Okay. Now what the question twists up for us is finding the capital employed for a limited company. Can you tell me what would be the capital employed for a limited company? You know, in a limited company, we prepare the statement of changes in equity that has the shareholders' funds.
Yeah.
The last column total of it, that is share capital plus reserves plus retained earnings or share.
Retained earnings. Yeah.
Yeah, the last total of it. Plus, do not forget to add the non-current liabilities. In a limited company, the capital employed is the share capital, ordinary plus
Yeah.
preference. Now, here also they can twist. Statement of changes in equity is only going to give you ordinary share capital. Statement of changes in equity only gives you which share capital?
Ordinary share capital.
Ordinary share capital. From the balance sheet or from the details, if you have preference share capital, you're going to add it. Plus the reserves, plus the retained earnings, plus the non-current liability. Non-current liability in your limited company is only your long-term debentures.
Yeah.
What happens is where the kids get confused is they only take the shareholders' funds and they forget the reserves. Or they only take the share capital and do not add in the reserves. This is the only twist for capital employed in limited companies. So, what is the capital employed in limited companies?
Shareholders funds plus non-current liabilities.
What are the non-current liabilities in limited company?
Debentures.
Debentures. Which shareholders funds you will take, only ordinary shares or ordinary plus preference both?
Both.
Shazib, I hope you're with me. Okay.
Yes.
So I'm giving you 2 minutes time. Now you're going to write everything that we did. Ratios, we have three types of ratio. One is a profitability ratio, one is a liquidity ratio, and one is the efficiency ratio. Now, when I'm talking about the liquidity ratio tells us how liquid are we. When I say how liquid we are, that means how much cash is available with us to pay our liabilities. When I say how liquid we are, that means how much cash is available with us to pay our liabilities. So, how much cash is available to pay our liability? So, we have two types of liquidity ratio. One is cash available within a period of 6 months, another is cash available within a period of 3 months. Okay, so 6 months is also called the current ratio. It is also called the working capital ratio. What is it called? Working
Working.
capital
Working
ratio.
capital ratio.
And the formula is current assets divided by current liabilities. So ideally, they say if your current liabilities is 1, your current asset should be double of it. It should be 2 times of it.
Yeah.
And it is always written as like this, 2 is to 1. Okay. Or maybe 1.6 is to 1, whatever you are getting up until 2 decimal places. So current
Yeah.
ratio tells us our short-term liquidity. Your current assets ideally should be double your current liabilities. It is always written is to 1. Like this is to 1, whatever it is. So if it is 2 is to 1, it means your current assets are 2 times your current liabilities. That means if you have
Yeah.
to sell your current assets to pay your current liabilities, you can easily sell them off and pay your current liabilities. Now remember, if you have your current ratio as 1.3 is to 1, that means what position it is giving about your liquidity?
You're not very liquid.
You're not very liquid, or you can ideal, or you can also say you're not very solvent. Your solvency position is not good. If the current ratio is 3 is to 1,
Then it's very good.
no, you will say the ideal current ratio is 2 is to 1. Anything above that, 2.1, 2.2 is fine. But when it is 3 is to 1, it means a lot of your money is tied up in the current assets. You could have used this money for some other opportunities. So this is not good. Okay? This is also not good. Too less is also not good. Too much is also not good. 2 is to 1 is the ideal appropriate liquid ratio. 2.1, 2.2 is okay. I hope you're with me.
Yeah.
Can you tell me 5 current assets?
Cash in hand, cash at
Uh,
bank,
Closing
trade
inventory, cash in hand, cash at bank,
other receivables,
other receivables, trade receivable,
And 3 current liabilities?
bank
bank
overdraft,
overdraft, trade payable, other payables.
Okay, other payables has?
Other payable has
pre-received income,
Hmm,
an outstanding expenses.
lovely. So you can identify your current assets, you can identify your current liabilities, divide it. Do not forget to write is to 1, that is the best method. Too less is not good, too much, that means too much cash is tied up in the current assets. What words you will use? Too much cash is tied up in the current assets.
Current
Another
assets.
liquidity ratio is liquid ratio. Liquid ratio, that means in 3 months of time, what is your solvency position? It is also called quick ratio, quickly, or asset test ratio. So what are these three other ratios? Quick ratio, liquid ratio, asset test ratio. What are these?
Asset test ratio.
Quick ratio, liquid ratio, asset test ratio.
asset.
From your current
Yeah.
assets, when you're going to subtract your closing inventory, be mindful, you have to take the proper closing inventory and subtract it. Current assets minus
Yeah.
closing inventory divided by current liabilities. Current assets minus
Yeah.
closing inventory divided by current liabilities. This is going to give you your quick ratio, liquid ratio, asset test ratio. Your ideal quick ratio is 1 is to 1. Okay. So
Yeah.
you have two liquid ratios. What are your two liquid ratios?
Your current ratio and your asset test ratio.
Current ratio, quick
Yes.
ratio, liquid ratio, asset test ratio. Working capital ratio is also which ratio?
Quick ratio,
Working capital ratio is also your current ratio. Okay. Working capital ratio is also your current ratio. What is the formula to calculate working capital? Working capital, that means the money needed for your day-to-day expense.
current, current asset divided by current liabilities.
Current assets minus current liabilities is your working capital. So what is working capital? Money needed for day-to-day expenses. What is working capital?
Money needed for
Money
day-to-day
needed for day-to-day expenses.
How do you calculate your working capital?
Current assets minus current
Current
liabilities.
assets minus current liabilities. But if they ask you for your working capital ratio, I'm changing the words. If they ask you for working capital ratio, how would you find it? If they have to ask you to find your working capital ratio, how would you find it? Working capital ratio. Working capital ratio is current assets divided by current liability. Are you with me?
Yeah.
Answer is expressed is to 1. So there is a difference between working capital. There is a difference between working capital ratio. What is working capital?
Working capital is the capital that like
Current
you
assets
need
minus
during the
current
business.
liabilities. What is working capital?
Current assets minus current liabilities.
What is working capital ratio?
Current assets upon current liabilities.
Okay, fine. So we learned the two types of ratios, fast. Profitability ratio, liquidity ratio. What are the profitability ratios? Markup is on.
Markup, margin.
Markup is on.
Markup is cost of sales. Margin is
Markup
on
is on cost of sales.
Margin is,
revenue. Is on revenue. What
yeah.
helps us to find profit for the year? No,
What
sorry,
helps
gross
us to
profit.
find the gross profit? What is the formula for gross profit markup?
Gross profit. Sorry, profit for the year divided by cost of sales multiplied by 100.
What is the formula for finding gross profit margin?
Gross profit divided by revenue multiplied by 100.
Okay, fine. What is the formula to find ROCE?
Non-current liabilities minus closing inventory.
ROCE.
Profit before interest, PBIT divided by capital employed
Okay,
multiplied by 100.
100. Profit for the year? Profit for the year? Shazib?
Yes. Profit for the year would be profit divided by revenue multiplied by 100.
Two formulas for finding capital employed?
Capital plus non-current liabilities, total liability minus current liabilities, or total assets minus current liability.
What is the meaning of capital employed?
The capital that is being used in the business.
Okay, fine. Liquidity ratio. What does the liquidity ratio tell you?
How much liquid is your company or business?
How solvent you are. Okay, what is the formula for current ratio? Formula for current ratio?
Current ratio.
Current assets divided by current liability.
Yes.
Okay, what is the ideal current ratio?
Two, one, two and like
2
two
1.
one.
Okay. What is the other name for quick ratio?
Quick ratio, liquidity ratio, liquid ratio,
And
acid test ratio.
what is the ideal quick ratio?
1:1.
Okay. How do you find working capital?
Working capital.
Current assets minus current liabilities. How do you find working capital?
Current assets minus current liability.
What does the working capital tell us? Money needed for
How much
day-to-day operations. What does the working capital tell us?
money needed for day-to-day operations.
Okay, fine. With this, we've completed profitability ratio, liquidity ratios.